Good afternoon. I'm John Schenk from Deerwood Realty, and I just flubbed that intro really bad. I started to decide I was supposed to announce my presence, like you don't know who I am, you're just random people out there, but it didn't go well. I could have been like, hey guys, it's John, but I don't know that would have helped, like you don't know who John is. But anyway, I'm practicing, and that's what we're doing. So wanted to go over this thing that I saw. So if you or I like do something wrong, or we want change, we could write a letter, but no one would care, right? Well, the housing industry is getting a little bit upset with the current situation. So they wrote a letter to the head of the Fed, Jerome Powell, to let him know that they were upset, right? It's always been funny, like if you look in Congress, if you watch those people, if you watch like a senator will say, he'll demand that the FBI release all documents related to such and such, and the FBI just tells him to go take a hike. They don't care. They don't care at all. And it's, back in the day, I was doing something, and I called my attorney, and he's like, well, what do you want me to do? Write a letter? Yes. He's like, okay, that's $250. That was back then with inflation. God, writing a strongly worded letter now would be probably at least $1,000, I'm thinking. Anyway, what I wanted to do is how I want to set this up is I'd like to read the letter first, and then we can go over some commentary on the letter, and just see where you sit and where I sit on this whole issue. So here it is, okay? And we'll just read it in its entirety because, we don't get to write letters that people read. Dear Chairman Powell, now this is from the National Association of Home Builders, the Mortgage Bankers Association, the National Association of Realtors. So yeah, I would say that these are, people that are very interested in how the housing market is working. It's regards providing market certainty on rate path and MBS sales. Those are mortgage-backed security. Okay, here we go. Dear Chairman Powell, that's nice to start off. The Mortgage Bankers Association, National Association of Realtors, and the National Association of Home Builders write today to the Board of Governors of the Federal Reserve System, hereinafter the Fed, to convey profound concern shared among our collective memberships that ongoing market uncertainty about the Fed's rate path is contributing to recent interest rate hikes and volatility. Oh, let's do that again. We're going to convey profound concern shared amongst our collective memberships that ongoing market uncertainty about the Fed's rate path is contributing to recent interest rates hikes and volatility. So what they're saying is because we don't know what you're going to do, other people don't know what you're going to do, and it's causing volatility. Okay, well that's, we never really know what the Fed's going to do. So, okay, it says this has exacerbated housing affordability and created additional disruptions for a real estate market that is already straining to adjust to a dramatic pullback in both mortgage origination and home sale volume. These market changes occur amidst a historic shortage of attainable housing. Now, we've heard affordable housing. They've gone with attainable housing. So they're saying because we don't know where the rates are going to go, it's hurting housing affordability because rates keep rising, and it's creating disruptions in the marketplace, which was the whole point of him raising rates in the first place. It says, according to MBA's latest weekly application survey data, mortgage rates have now reached a 23-year high. This was of October 9th, dragging application activity down to a low last seen in 1996. I graduated high school in 1995. The speed and magnitude of these rate increases and resulting dislocation in our industry is painful and unprecedented in the absence of larger economic turmoil. And I would just disagree with that. We have a massive amount of economic turmoil. It's just being papered over. I mean, inflation is a real problem, okay? And the Fed is trying to fix that real problem. But there's also this thing called spending. And the government is spending and spending and spending and spending and making our money worth nothing. Anyway, today the spread between the 30-year mortgage rates and the 10-year Treasury yield is at historically high levels, signaling deep-seated uncertainty about where the Fed is headed. That spread, to be honest with you, has been there the whole time that they've been raising rates. And it tends to indicate that it's supposed to indicate definitely of uncertainty amongst the bond traders. That's the theory. And you know what? I don't think they're too far off from that. The difference between the current spread and the long-run average indicates mortgage rates for homebuyers across the country that are at least 120 basis points higher than they otherwise would be. In other words, the uncertainty-induced mortgage-to-treasury spread is costing today's homebuyers an extra $245 in monthly payment on a standard $300,000 mortgage, which, by the way, is not even a median-priced home anymore in the United States. Further, rate increases and persistently wide spread pose broader risks to economic growth, heightening the likelihood and magnitude of a recession. And so, if you get this, like, do you think that Chairman Powell actually reads this, or do you think he has one of his people read it? And even then, like, they're saying if you keep raising rates with these spreads, you're going to hurt the industry. And his whole thing is he's going to try and hurt the industry. That's what he's been tasked to do. There's been inflation, and now that he started, or the Fed started, and now they're going to put it out by raising rates to ridiculous levels. Furthermore, a leading source of inflation in recent months has been increases in shelter costs. In the August CPI report, consumer prices were up 3.7%, while shelter costs were up 7.3%. In July, shelter inflation was responsible for 90% of the gain for consumer prices. The most effective approach to tame shelter costs and assist on the broader inflation fight is to facilitate the construction of attainable, affordable housing. There's that word, affordable housing. We know what that means. That doesn't mean what they write. Sustained wide spreads or further increases in interest rates make this economic goal more challenging by limiting lot development and home construction, exacerbating housing supply, and pricing out millions of households from the goal of home ownership. So here's my problem with that is, look, the inflation is raising its head in many different places, and it's definitely in housing. There's no doubt about that, but that's why they keep raising the rates. We strongly urge the Fed to make two clear statements to the market. So they're saying now, Fed, you need to go ahead and do this or else we'll be upset. The Fed does not contemplate further rate hikes, and the Fed will not sell off any of its mortgage-backed security holdings until and unless the housing finance market has stabilized and mortgage-to-treasury spreads have normalized. The Fed should not ever say that they will not contemplate further rate. They should not. They don't speak to the National Association of Home Builders or Realtors. They don't care. It's not their. They don't care at all. And then the Fed will not. Now you're telling the Fed what to do with its balance sheet. Like, do you think that they really care? These steps will provide the market greater certainty about the Fed's rate path and its plans for the mortgage-backed security portfolio and reduce volatility for traders and investors. Greater market certainty doesn't matter when interest rates are at 8% or mortgage rates are at 8% and the median price of a home is over $400,000. Like, we don't need finance stability for that to be the case. And I would just ask, like, look, in 1996, when the mortgage applications were at their lowest, was there financial stability then? What about in 1980? See, this letter is nonsensical. It's not based in the real world. Housing activity accounts for nearly 16% of the GDP, according to the National Association of Home Builder estimates. We urge the Fed to take these simple steps to ensure that this sector does not precipitate the hard landing the Fed has tried so hard to avoid. Well, it's coming. It's coming. So then now, so what was the point of the letter? The point of the letter was to market the National Association of Home Builders, National Association of Realtors, and the National Association of Mortgage Folks. I forgot their name. I'll get it. I feel bad. The Mortgage Bankers Association. Okay. So, but then now they're hoping to get a response in the media, like to pick up on the story, to put more pressure on the Fed. And so let's look at an article written on CNBC and see if we think it's, decent. All right, here it is. And somehow I got to the end of it again. I didn't put it at the top, and I'm sorry. So it says, housing industry urges Powell to stop raising interest rates or risk an economic hard landing. If you think that a hard landing is not coming already, we just disagree, right? So let's get into it. It says that top real estate and banking officials are calling on the Federal Reserve to stop raising interest rates as the industry suffers through surging housing costs and a historic shortage of available homes for sale. And I just want to reiterate, surging housing costs are a result of the inflation. The Fed is trying to tamp down inflation because you have surging housing costs. 16% of the economy is based on the housing market, and you've got massive inflation there. So the Fed's doing what it's been tasked to do. We can disagree with how it does it, and we can say we don't like it. My transactions are just terrible right now as a real estate agent, right? Because my buyers aren't buying and my sellers aren't going to sell. They're the 3% fixed mortgage. They don't want to sell. So all that's coming to the market is people that have passed, people that are divorced. If you have to move for a job or something like that, those are the people that are moving. It's not anybody else. If you've got a house right now at 3%, you're probably not going to list it anytime soon. But the Fed caused that because they had unnaturally low rates to try to spur the economy. So anyway, in recent days, several officials have noticed that the central bank could be in a position to hold off on further increases as it assesses the impact the previous ones have had on various parts of the economy. However, there appears to be little appetite for easing, with the benchmark Fed funds rate now pegged in a range between 5.2 and 5.5%, the highest in some 22 years. And again, I would say that the Fed probably should have started earlier and should have waited. They said that it can take up to a year before any sort of interest rates, the effects of raising interest rates will show up in the economy. I don't know if it's true. I'm just saying that's what's said. At the same time, the housing market is suffering through constrained inventory levels caused by artificially low rates and investors buying millions of properties. Prices that have jumped nearly 30% caused by inflation, okay, after you printed all kinds of money for various reasons. Since the early days of the COVID pandemic, and sales volumes that are off more than 15% a year ago, caused by the combination of high interest rates, which are from the Fed, and constrained inventory levels, also because of the Fed policy. They've really put themselves into a hole here. It says, the letter notes that the rate hikes have exacerbated housing affordability and created additional disruptions for real estate market that is already straining to adjust to a dramatic pullback in both mortgage origination and home sale volume. These market changes occur amidst a historic shortage of attainable housing. Well, I mean, the prices went up because of inflation. The rate hikes have not really exacerbated it as much as it kind of showed like, hey, inflation is here and it's in housing, definitely in housing, and we probably need to do something about that. At recent meetings, Powell has acknowledged dislocations in the housing market. During his July news conference, the chair noted this will take some time to work through. Hopefully more supply comes online. But as the rates keep going up, you're going to start seeing less and less construction. What's putting people, what's allowing developers to still try to develop homes at this point is the fact that prices haven't collapsed. I mean, if prices start going down and your interest rates are going up, you're not going to like that as a developer. It says the average home price has climbed to $407,100 with available inventory at the equivalent of 3.3 months. NAR officials estimate the inventory would need to double to bring down houses. And look, if we're at 6 months on, or more than 6 months on available listings, that becomes a buyer's market, okay? But man, we're still 3 months off from that. You've got a serious problem here. The speed and magnitude of these rate increases and the resulting dislocation in our industry is painful and unprecedented in the absence of larger economic turmoil. I told you about this when we were reading the letter. I don't agree with this. I would say the speed and magnitude of the price hikes due to inflation, the asking prices of homes, would be the biggest problem. The inflation part is worse than the rate increases, in my opinion. So that's that. I put it right down here. What do you all think? You should put it in the comment section. You should talk about this. I mean, maybe you don't agree with me. Maybe you think that house prices are okay, and it's just the interest rate that's the problem, the mortgage rate. Now, I doubt that I'll be convinced otherwise. I'm pretty set in my position here. As far as the Fed selling mortgage-backed securities or things like that, I'm not going to get into that on this particular episode because it's a whole different deal. But it's like the Fed, being the Fed is an odd position. You're always going to be being attacked by someone for something, rightly or wrongly so. I mean, the Fed does not control spending. Congress controls the spending, and look at what they've done. So with that, I'm going to head on out. Thank you for watching. Thank you for listening. I will catch you on the next one.